Welcome to the Friday edition of Tech Stocks Daily. Ready to kick off the weekend with some sizzling tech news? Today, we've got H&R Block skyrocketing after a stellar earnings report, Meta hitting pause on its GTA VR project while still attracting hefty investor interest, and Apple wowing us with its upcoming AI-powered iPhone 16, and a legal win bringing Fortnite back to the App Store. Oh, and Accenture's exciting growth tales you don't want to miss. Stick around, it's going to be a wild ride through today's NASDAQ sensations. Buckle up, folks. Today we've got some major moves shaking up the stock market, and leading the charge is none other than H&R Block. That's right, your go-to tax prep giant is making some serious waves on Wall Street. So grab your calculators, and let's dive into why H&R Block is hot news today. First off, H&R Block shares are skyrocketing, surging 12.2% to be exact, closing in at a spicy $64.48 per share. What's fueling this dramatic uptick? Well, the company dropped the bombshell of a fourth quarter financial report, smashing all expectations like a pro athlete breaking records. So here are the juicy details. H&R Block reported a fourth quarter revenue of $1.063 billion, cruising past the $1.28 billion that analysts had braced for. And if you thought that was impressive, their earnings per share came in at $1.89, outplaying the expected $1.74 by a nice margin. Talk about going above and beyond. But wait, there's more. The company didn't just exceed expectations, it also upgraded its future outlook. H&R Block projected their full-year revenue to hit between $3.69 billion and $3.75 billion. That's more than what analysts had penned down at a modest $3.575 billion. And if that's not enough to make you want to moonwalk, their adjusted EPS forecast for the full year is set to rock between 5.15 and 5.35 cents, significantly higher than the previously estimated 4.30. Let's talk bonuses. H&R Block is also rewarding its shareholders by boosting its quarterly dividend by a glorious 17%. That's like getting an extra scoop of ice cream on your sundae. This marks the 7th consecutive dividend increase in 7 years. They're not just stopping there. The board also gave the thumbs up for a new $1.5 billion share repurchase program. Yup, that's right, a billion with a B. Okay, hold your applause for a second because there's another kernel of goodness here. Driving these rockstar financial metrics is the robust performance in what H&R Block labels its assisted category, which saw higher net average charges and volumes. Stronger online paid returns also contributed to this financial magic show. Plus, H&R Block showcased their knack for staying ahead of the curve by introducing AI Tax Assist, which worked like a charm in converting new clients. Apparently, this AI wizardry led to higher new client conversions. Financially speaking, the company was flush with cash. They wrapped up the quarter with a cool $1.1 billion in cash and cash equivalents, compared to $794.61 million from the previous quarter. As for long-term debt, it stayed flat month over month, sitting pretty at $1.49 billion. Zooming out, over the past year, H&R Block shares have gained a whopping 48.2%, outstripping the broader industry's growth by a sizable margin. We're talking leaps and bounds here. The industry it's a part of saw an 11.3% increase, while the Zacks S&P 500 index grew by 23.8%. In summary, H&R Block is not just hitting home runs, it's knocking them out of the park. With record-breaking financials, future-forward innovations like AI Tax Assist, and a commitment to rewarding shareholders through dividends and stock buybacks, H&R Block is the MVP of today's tech market news. So keep your eyes peeled, stock enthusiasts. H&R Block is one to watch. Hey tech enthusiasts, buckle up, because Meta Platforms, the company formerly known as Facebook, has stirred the tech universe today with several attention-grabbing updates, ranging from financial aches to intriguing investor behavior. First off, let's dive into the big news. Meta has put its highly anticipated Grand Theft Auto San Andreas VR project on ice. Yes, after 3 years of building hype and big announcements, they hit the brakes hard and said, nope, not now. This indefinite hold is a massive hit to Meta's VR dreams, which were heavily promoted by their Reality Labs division. It's like planning an extravagant birthday bash for years, sending out all the invites, decking the halls, and then canceling because the cake caught fire. Why would Meta do this? Well, maybe burning holes in your wallet to the tune of $16 billion in VR-related losses for just this year might make you reassess your priorities. That's right, the company's VR division has been hemorrhaging funds, and this has probably propelled them to push GTA VR into a corner to focus on more immediately profitable ventures. Guess digital open worlds aren't worth it if they cost a real-world fortune. Speaking of fortunes, you want to know how Meta holds up in the cutthroat realm of interactive media and services? According to some fresh numbers, Meta is juggling both favorable and questionable stats. Its price-to-earnings ratio is lower than the industry average, implying that it might be undervalued. But wait, there's more. Its price-to-book and price-to-sales ratios are on the higher end, suggesting it might actually be overvalued in terms of its book value and general sales performance. However, when it comes to productivity and profitability, Meta is flexing some serious muscles. Their return on equity is significantly above the industry average, and their EBITDA stomps most of its competition. Rounding all this off with a cherry on top, deep-pocketed investors, or whales as we call them, are showing a bullish interest in Meta. Benzinga's options scanner flagged 15 extraordinary options activities today alone. What does this mean? Despite the issues, VR delays and all, there's heavy trading interest, with big market movers placing substantial bets on Meta's stock. Generally, the sentiment leans bullish, with the majority content to see some upside in the next price band between 520 and 540. To sum up, Mark Zuckerberg's Meta isn't just the social network overlord you scroll through mindlessly. It's a fintech battleground with its own sets of struggles and wins. While burning cash on VR might make your head spin harder than a VR roller coaster, savvy investors haven't shied away from betting big on this tech titan. There's never a dull day in Metaland. And today's headlines serve as a fascinating snapshot of what's stirring in Menlo Park. Stay tuned as we continue to watch and, of course, keep ourselves entertained. Hey everyone, strap in because today's tech news spotlight shines brightly on none other than Apple. All right, so why is Apple making headlines today? Let's dive right in. First off, we've got some juicy deets on Apple's impending iPhone upgrade cycle. The tech giant is prepping to unveil the iPhone 16 next month, and this isn't just any ordinary release. This baby is packed with AI integrations. Apple has partnered with OpenAI, so you can expect Siri 2.0 to have ChatGPT-level language skills. Not just that, but you'll also get to create stunning images and have dialogues that are a lot less robotic, shall we say? Think of it as having a mini creative director in your pocket. Now, why should we care? Great question. With more than 2 billion active Apple devices globally, the implementation of advanced AI is a massive deal. Apple is expected to see considerable growth thanks to this upgrade cycle. Investors are buzzing, stock prices are near all-time highs, and with good reason. Talking about stocks, there's some heavy action in the options trading arena. If you're into the world of options, you know that calls and puts are like a seesaw for potential gains. Apple options specifically have been a hot topic. Traders are showing a substantial bullish sentiment, with 40 out of 47 notable trades being call options valued at a whopping $2.5 million. That's right, optimism is high, y'all. Apple has a Zacks rank number 3 rating, and its industry group is performing well, ranked in the top 41% of more than 250 Zacks ranked industries. Bottom line, the stock is ripe for some serious upward movement over the coming months. Next up, remember Fortnite? The gaming hit has clawed its way back onto the iPhone. Epic Games, backed by Tencent, has finally won a legal scuffle with Apple. Fortnite returns to the App Store, but not alone. It comes with an entire App Store available in the European Union. Epic's been in a legal brawl with Apple for 4 long years, accusing them and Google of stifling competition with their App Store policies. Well, the Digital Markets Act seems to have come to Epic's rescue, forcing Apple to let Fortnite strut back in. Moreover, Epic's not stopping there. They announced they'll be launching their own Epic Games Store, allowing various developers to roll out apps and games. As Tim Sweeney, CEO of Epic Games, puts it, the fight is far from over, but this marks tangible progress for developers and consumers. Outside of Europe, though, Apple is still playing hard to get, blocking iOS users from accessing the Epic Games Store. So there you have it. From iPhone 16's AI magic and bullish stock moves to Fortnite's triumphant return and the larger war for App Store dominance, it's been an Apple-flavored news day. Stay tuned. Who knows what the tech titan will pull out of its hat next? All the juice, folks. Let's keep those fingers crossed for more Apple awesomeness. All right, tech enthusiasts, let's dive into why Accenture PLC was making waves in the news today. Accenture shares have been on a roll, gaining 7% over the past 3 months. That's pretty impressive compared to the modest 1.1% growth of the industry it belongs to and the 2.4% rise in the S&P 500 composite. This strong performance is backed by some solid fundamentals and the company's impressive growth score of B. That's a neat little grade that sums up all the vital financial metrics to give you a clear picture of the company's growth quality and sustainability. For those planning to hold on to their Accenture stock, here's why you might want to stick around longer. The long-term earnings per share for the company are projected to grow at 7.5% over the next 3 to 5 years. Plus, earnings are expected to rise by 2.4% in fiscal 2024 and a further 5.3% in fiscal 2025. These are some solid numbers, indicating that Accenture is on track for consistent growth. Accenture's growth strategy revolves around delivering 360 degrees value to its stakeholders, heavily leveraging technology. They're all about building a digital core and investing in cloud, data, AI, and their talented workforce. This makes Accenture a steady and trustworthy partner for their clients. They've also been witnessing strong demand in sectors like application modernization, cloud enablement, and cybersecurity as a service. All these trends have positively impacted their managed services business worldwide. In fact, their managed services revenues saw a 2% year-over-year increase in Q3 2024 and an 11% rise in fiscal 2023. They're heading towards an estimated revenue growth of 4.5% and 4.8% for fiscal 2024 and 2025 respectively. On top of that, Accenture isn't shy about acquiring other companies to beef up their expertise in high-growth areas. They spent a whopping $2.5 billion across 25 acquisitions in fiscal 2023, making sure they've got all the right skills and capabilities to stay ahead in the game. And hey, who doesn't love a company that's committed to rewarding its shareholders? Accenture has been dishing out steady dividends, 2.8 billionaires in 2023, 2.5 billion in 2022, and 2.2 billionaires in 2021. Expected steady income and cash flow are bound to translate to continuous stable dividends. Their net income growth projections of 5.2% for fiscal 2024 and 5.8% for 2025 sure look promising, but it's not all sunshine and rainbows. Accenture is also navigating some challenges like higher talent costs due to a highly competitive market. On the flip side, advancements in automation and AI could present both opportunities and uncertainties. Technology can be a tricky balancing act. For context, two other contenders in the tech sector are standing out as well: Charles River Associates and DocuSign. CRAI boasts a Zacks ranked number 1 and has shown impressive growth, even outperforming with a 53.7% rise in shares over the past year. DocuSign, ranked at number 2 by Zacks, also has some healthy growth expectations. So, what do you think about Accenture's position and future growth prospects? Do you believe in its strategies, or do you see challenges overshadowing the opportunities? Drop your thoughts and let's get the conversation rolling in the comments. All right, tech fans, let's dig into the mega moves in the stock market today. We're diving eyebrows first into H&R Block. Yeah, the tax prep maestro is making some serious waves on the NASDAQ. So should we buy, sell, or hold H&R Block given today's roller coaster ride of news? Drumroll, please. I'd say buy. Here's why. 1. Financial report blowout. H&R Block has blown past even the wildest analyst expectations, with fourth quarter revenue hitting $1.063 billion, well above the anticipated $1.28 billion. Their earnings per share, a cool 89, skating past the expected $1.74. These aren't just numbers, they're power moves. 2. Upgraded outlook. Hold on to your hats, folks, because H&R Block is projecting full-year revenue to land between $3.69 billion and $3.75 billion. Analysts were feigning at the sight of their modest $3.575 billion projection. And speaking of EPS, the forecast cranked up to between $5.15 and $5.35, way ahead of the previous $4.30 forecast. 3. Shareholder rewards. Who doesn't love some extra icing on their cake? H&R Block boosted its quarterly dividend by 17%, marking their 7th consecutive hike in 7 years. Plus, the board approved a dazzling $1.5 billion share repurchase program. That's billion with a B, people. 4. AI-powered growth. Their AI tax assist isn't just some gimmick. It's converting new clients left, right, and center. Innovation plus solid financials? That's a cocktail set to impress even the pickiest investor. Given this spicy cocktail of strong earnings, future-forward AI strategies, and generous shareholder rewards, I'd reckon H&R Block is looking prime for a buying spree. But hang on, I'm not a financial advisor, so make sure to do your own research and consider chatting with a financial advisor before diving into any stock market journey. There's always a mix of risk and excitement in the world of investing, and you gotta play it smart. Today's tech news on the NASDAQ was buzzing with excitement. H&R Block soared with smashing financial reports and impressive future projections. Meta hit the brakes on its highly anticipated VR project, but still sparked investor interest. Apple dazzled us with its upcoming AI-infused iPhone 16 and welcomed Fortnite back to its App Store after a legal win. And Accenture impressed with consistent growth, innovative strategies, and healthy shareholder rewards. If you enjoyed this breakdown, don't forget to like, subscribe, and share the video with others. Make sure to drop by again on Monday for another exciting market update, and have a fantastic weekend.